Some key statistics you'll see at the bottom here, which highlight the diversity, the size of AIM now, the size the market is growing into. We have just over 1,100 companies on AIM, and as you'll see, the stats here say we have 221 international companies. Well, that actually understates the international nature of the market, because those international companies are simply companies that are incorporated outside of the UK or outside of an onshore, offshore UK jurisdiction, such as the Isle of Man or the Channel Islands. Clearly, as you'll hear later from a number of the speakers, companies will structure their transactions in a way which will include a top company structure domiciled in one of those jurisdictions. So if you include those companies into the mix, you'll see that approximately 40% of AIM by the number of companies nowadays are made up of international companies. I think really highlighting how this market has become very, very key for international companies as a financing route. The other key stat I think I'd like to draw on here is really just looking at the total amount of money raised on AIM since its inception, and really how that splits between the money raised at admission, at IPO, through further issues. So you'll see that AIM has seen just over £75 billion raised. So that's probably about exchange rates move around a bit, but that is approximately 110, 120 billion US. And you'll see from that actually the majority of funds raised, slightly over 55% of the funds raised on AIM, have actually been raised by companies in the secondary market. So after they have listed on AIM, they've come back to the market 18 months, 2, 3 years down the line, and they have used the unique structure of AIM, the unique regulatory structure, the unique investor base of AIM, to be able to tap those financing sources and do so at a higher price potentially than they listed at, and to do so when it's the right time to raise funds. I think that is a very key differentiator between AIM and markets here or other growth company markets globally, where you see much more of an opportunity to raise funds being a one-shot approach at the IPO, and you have to raise what you need at a certain price, and that price might be lower than the price you might achieve 2 years down the line. So really just drawing on a few of those extra points, I spoke about how the nominated advisor was an absolute key role, and you'll hear a lot more from Managaer on the responsibilities they have as a nominated advisor, and really what that brings to companies and to AIM. We see that role as being absolutely key. I think if you look at the philosophy we have for AIM, which is really to operate a market that is giving companies, smaller companies, access to a very, very high quality institutional investor base at an earlier stage than they would have otherwise been able to achieve. I think you see the nominated advisor model being absolutely key in facilitating that. You're taking a company, globally focused investment bank, securities firms such as Managaer or one of the 60 other nomads we have on the market, really putting their name and putting their reputation alongside a company that is really might be a much younger company, and the management of that company may not have prior experience of being a publicly listed company. And really tying that relationship together means that you get a lot of investor confidence really in AIM, and that you see in AIM an investor base that looks very similar to the investor base we have in London as a whole. Very high degree of willingness by institutional investors in London to invest in AIM. A couple of key points to talk about as well. With AIM, there isn't a minimum market cap requirement, and there isn't a minimum requirement to have, say, a 2 or 3 year trading record, a record of accounts. And also there isn't a formal requirement for AIM companies to have a minimum amount of shares or free floats to be in public hands. Our main market, for example, mandates that companies have a 25% free float. There isn't a formal requirement on AIM. There is an informal level. Clearly, a company with a free float of 1 or 2% would not be suitable for AIM. We would face a very volatile secondary market for that company. I think you would find a conflict between our regulatory requirements of the LSE of having to run orderly markets and a company being that tightly held. But AIM can and does facilitate sell downs by companies of between 10 and 15% is in many cases a normal amount for an IPO on AIM. And very much the rules and the regulatory model we have on AIM and the admission requirements on AIM are tailored for the needs of smaller companies, but also balance those needs that the company has with the desire and the requirements of investors to see a high level of disclosure and a high level of evidencing of that company's financial history and risks facing that company. In terms of ongoing requirements, you'll hear a lot more of this later, so I won't cover all of these points, but the nomad is key. It is required to be retained by the company at all times. A couple of other points to highlight. Unlike here in India, we don't mandate quarterly reporting in London or on AIM. Half-yearly reports are required. But in terms of an ongoing disclosure regime, we have the company must submit electronic filings on the London markets if anything of a price-sensitive nature happens on the company. An inevitable question facing any Indian issuer thinking of listing in London is how does that ongoing disclosure regime knit in with what you face here in India. And in many cases you find the disclosure requirements being very much in line with each other. You see very few instances or no real instances of one set of rules being contrasting or conflicting with the other. And I think you see an intelligent approach, really looking at one disclosure regime next to the other and making sure that you're complying with the most onerous in whatever scenario you find yourselves in. So really, looking at these in a round, I think it's worth drawing out one major point at this point about that I hear often here in India, which is given AIM's situation as a growth companies market, given the fact that you don't mandate a minimum size or a minimum free float, does that lead AIM to be a very illiquid market? Does that lead to problems in the secondary market in terms of financing? And I think there's a number of perceptions on that here in India and in other markets internationally. I think a number of those perceptions are not entirely correct. I think it's absolutely worth stressing that liquidity is very much a function of the structure that the company chooses when it comes to AIM. If a company is expecting to come to AIM with a free float of 15%, key benefit of AIM is coming to the market and accessing a very high quality institutional investor base. And those investors invest over the long term. They'll stick with the company for 2, 3, 5 years. You are going to see a secondary market environment that reflects those choices that the company makes at IPO. I think, however, though, if you look at companies, if you compare their free float level, if you compare their size, if you compare those companies on AIM, if you compare them here in India, if you compare them on the main market, I think on AIM you see liquidity levels, velocities of circulation being in line with what we see in London on the main market, and in many cases also being in excess of the liquidity that can be achieved on the markets here in terms of ongoing turnover, once you account for the fact that an AIM issuer might have a much lower free float than one here in India. The other factor that also comes across when I speak to people in India is how has AIM performed in recent years? How has the market performed in a macro sense, and how has it performed here in India? Well, firstly, you'll see what really doesn't look a very pretty picture in terms of if you were sitting here as an investor, in terms of performance of AIM versus other growth companies markets, such as the entry standard in Germany, the Euronext growth companies market, Hong Kong, TSX. But I think what you see on AIM is a lower degree of volatility. You see AIM suffering a lower sell down, a lower drop off in broad index values during the crisis, and actually you see AIM also being quite resilient on the upside. And really, I think a number of factors here are at play. Firstly, the investor base, a more stable, more institutional investor base, and secondly, the very diverse range of companies on AIM. AIM has companies from 24 sectors. It is a market that is not just reliant on technology, it's not just reliant on natural resources, and that sectoral diversity, I think, brings a lot of stability to the market. And if we focus in greater depth in terms of how has AIM compared to markets here in India, I think you see a very interesting pattern, which I think pulls out a couple of key factors that really do impact companies' financing choices here in India at the moment. Certainly over the last 12 months, you'll see a divergence of performance on AIM compared to FTSE 100 even, and also particularly compared to domestic sectors here in India, so the benchmark BSE and the Sensex, and also